On 9th February 2026, the Monetary Policy Committee, MPC, of the Bank of Uganda, BOU, maintained the central bank rate, CBR, at 9.75%. The committee assessed that the prevailing policy stance remains appropriate to support economic activity while ensuring that inflation stabilizes around the target over the medium term to long term amid persistent global economic uncertainty. Inflation has remained below the medium-term target of 5%, reflecting the impact of prudent monetary policy, complemented by coordination with fiscal policy, a stable exchange rate, declining global inflation, and favorable food and energy prices. Over the 12 months to January 2026, annual headline inflation averaged 3.5%, while core inflation averaged 3.8%. Headline inflation edged up marginally to 3.2% in January 2026 from the 3.1% in December 2025, reflecting higher inflation in some core components, partly offset by a decline in food crop inflation. Similarly, annual core inflation increased to 3.3% in January 2026 from the 3.1% in December 2025, driven mainly by higher services inflation, particularly in the passenger air transport. Annual food crop inflation moderated to 3% in January 2026 from the 4.4% in December 2025, supported by favorable weather conditions. Energy, fuel, and utilities inflation rose slightly to 1.7% from the 1.4% over the same period due to modest increases in firewood prices. The inflation outlook has been revised slightly downwards relative to the November 2025 forecast round, reflecting the effects of modest exchange rate appreciation and lower international oil and food prices. Inflation is projected to remain slightly below the target in 2026, within the range of 3.8% to 4.3%, before stabilizing around the medium-term target of 5%. This outlook is supported by continued prudent monetary policy, stable exchange rate conditions, and moderating global commodity prices. Risk to the inflation outlook, both upside and downside, remain elevated.
Why do I say so? Remember, over the course of the last year, we are seeing monetary growth, private sector credit growth around 8%, 9%. And we have always argued that for monetary aggregates to grow in the range of 8 to 9%, that is really a contraction, in the sense that with nominal GDP of around 11 to 12, at least you require monetary aggregates to grow in the same range of 11 to 12. So what therefore we are seeing with the growth of monetary aggregates in the range of 12 to 13% is really not something that should be unusual. It is not that there's too much liquidity in the system that would warrant monetary policy tightening. So overall, we believe that the current monetary stance adequately addresses all the issues in terms of allowing sufficient monetary aggregates growth, while at the same time making sure that there is no inflationary pressure arising from that.